the supplemental liquidity ratio, which is put on commercial banks, which produce most of the money, and that supplemental liquidity ratio, the reserves they have to hold for liquidity purposes, that's going to be eliminated. So the banks will have a lot more capacity to lend than they do now, and they produce actually about 80% of the stock of M2 has been produced by commercial banks. So what do you have? You have maybe a big loosening coming up. Plus, you've got every day almost, you've got either Bessent, the Secretary of Treasury, or Trump himself whining because the interest rates, the Fed funds rate, aren't falling fast enough. So you've got, and you've got the deficit overhang. So there's pressure on the Fed to monetize the deficit. So all of that says what? It says maybe. I'm not saying this is going to happen, but it looks like things are getting set up for a significant loosening of monetary policy. And if that's the case, you can kiss the inflation contraction story away. The inflation will go up.
You're watching CapitalCosm. My name is Danny. It is November 12th, 2025, and my guest today is the much esteemed Professor Steve Hanke. Steve, thank you so much for coming on the show, my friend.
Well, thank you for inviting me, Danny. Good to be with you.
Yeah, it's always a pleasure having you on, Professor Hanke, especially in these times where the markets are just all over the place. So many things occurring, not just in the markets, but also in the economy. And I would also like to remind my audience and bring to their attention that this episode is brought to you by theforecaster.biz. We have a special 10% off discount. We are going to be using some of the charting tools that they have available at theforecaster.biz. So let's go ahead and dive right in here, Professor Hanke. What's your general overview of the market? Let's just start off very high level and take it from there. The S&P, the NASDAQ, the Dow Jones have all been kind of moving choppy to sideways. Gold's been getting a pretty good, decent bid. It skyrocketed up to $4,400 a few weeks ago. It took some time to recover. Now it seems like it's pumping back up again. What do you make of some of this action in the markets?
Well, let's start with gold, since that's the last one that you mentioned. It did pull back from 4,400 to 4,000, right around 4,000. It's consolidating, and if you look at the options market, we got the calls about double the number of calls than puts at 4,000. Those are expiring November 24th, those calls and puts. So the investors or traders, if you will, think the market's going up from 4,000. It's consolidating at 4,000, but going up. And as I've indicated to you before, I think this secular bull is in place and probably will peak out around 6,000 an ounce.
So 6,000 an ounce. We're currently at 4,400 and some change. So if we look at some of the cool tools that we have here on the forecaster, their projections, they use their machine learning models in the background to kind of crunch these numbers. When it comes to gold, their best projection is at price level of 44.79 by the end of the year. Obviously you're kind of projecting further out than that. You can kind of see the bull case is 46.70, something like that, and the bear case is just kind of flat to where we are today. I just wanted to put that out there. So how does gold play out in this interest rate environment that we're finding ourselves in? Because what's happening is we've had 2 consecutive episodes of rate cuts so far in the last couple of months, and the 10-year yield, which we can see here, has not moved in tandem with the Fed funds rate. Is this a matter of the market not buying what the Fed is doing? What's going on here with the interest rates, Steve?
Well, the key thing is that the federal funds rate is an overnight rate, and the 10-year, the duration
Mm-hmm.
is, literally 10 years longer than the Fed funds duration. And the Fed funds is controlled by the Fed. The 10-year is not controlled directly by the Fed. The market determines where the Fed fund where the 10-year is going to be, and as you implied, the 10 year is not quite buying into the fact that they've reduced now the Fed funds rate
Mm-hmm.
considerably, and will probably reduce it some more in the December meeting of the Open Market Committee. But interest rates are tricky because people don't understand the so-called Fisher effect is that they they they, they the short-term rate controlled by the Fed moves in one direction. It goes down, and everybody says, "Oh, rates are going down." But the next thing that happens, if that rate going down implies that the monetary policy is going to be looser, that means that with a lag, inflation will seep into the system. More inflation will come into the system, and that means then the longer duration bonds will the interest rates will go up, the prices will go down. So they move in opposite directions actually. This but the timing is different. There's a lag between the time that
Mm-hmm.
the Fed funds rate are actually changed and the longer term bonds alter, their yields are altered. So
Yeah, I mean, so as we can tell just by looking at this data from many different time frames over the last 20 years, it's the 10-year yield's gone down a whopping 11.5%. But within just the last 3 years or so, we're up 5%. I mean, does this breaking of this downtrend, this multi-decade long downtrend that we've seen in yields, portend to anything significant? Are we in the process of seeing capital rotate into, from growth and that kind of thing and into more value? Is that what it's implying? What are some of the implications here
well,
behind this breakup?
I think that the chart tells the whole story. We had the longest bull run in bonds, probably in history, and the bull is, we've pivoted into the, the bull market has come to an end. The longest bull
Mm-hmm.
market, probably in the history of bonds, did come to an end, and you can see it clearly on that chart. That's
Yeah.
that's
Yep.
that's what the chart is telling us, and it was a great bull run. I mean, we basically went from what 19 early 1980s until your chart doesn't even go back that far at the start of the bull, but it started in the early 80s and just ended, in the last couple of years.
Yeah. Yeah. So if I pull up the AI agent here, it can kind of tell us what's happening. It can kind of give us like a summary in terms of what's happening with the 10-year yield here. And I think it's going to say something very similar to what you just said. But what are the implications of the bond rally ending? What does that mean for stocks? What does that mean for gold? What does that mean for all of these other markets?
Well, the big thing that it means when it comes to taxpayers is that we're now running fiscal deficits of about 6%, 7% a year in the United States, and those deficits will have to be financed by the issuance of Treasury securities, and the interest on those is going to be high, and the volume of issue will be high. So So not only the yield is going to be high, but the quantity of paper that's going to be issued will be large, and it's going to suck up a lot of taxpayers' taxes are going to be used for what? To service debt. I mean, they're not going to get anything. This old Keynesian myth that unfortunately students learn it in most of their principles of economics books, that we don't have to worry about debt. It's not a burden. Well, it is a burden, because if you run a deficit today and issue debt, and you've got to service that debt, who services it? Well, taxpayers in the future. Maybe some taxpayers, they aren't even born yet. They're going to be servicing it and paying interest on it, and essentially getting nothing.
Yeah.
They're just servicing debt.
And,
So
and
so
so,
so so it's a huge burden. The debt always has to be paid back. Either you're servicing it with interest and amortization on that debt, or the other aspect is that oftentimes, and the debt will be monetized by a central bank, and inflation will pick up as the monetization of that debt increases the money supply, and then with a lag you get more inflation. So you're either going to pay it directly with taxes, your annual tax bill, or you'll get an indirect inflation tax.
and so you kind of add on like this cocktail of policies that we're kind of downstream of now. They're talking about ending quantitative tightening. They're talking about cutting the Fed funds rate. They're talking about these $2,000 stimmy checks, which we now have an update on. Secretary Bessent said, it's probably going to be limited towards people making under $100,000 a year. You have these 50-year mortgage loan ideas, 15-year car loan ideas. What are some of the ramifications of all of this stuff? Because it's just this increased financialization on the part of these 50-year mortgages and 15-year car loans, and then you've got liquidity coming back into the market through these stimmy checks. What is all this portending?
Yeah, well, the big thing is that we've had, since we've been kind of on a roller coaster. We had what happened. COVID came. We had big fiscal deficits. Most of those deficits were monetized by the Fed, and that increased the money supply tremendously. And we had inflation as a result of that. Then the Fed got spooked and started tightening up, and we had a contraction in the money supply. And with the contraction of the money supply, following that, inflation starts coming down, down, down. It's on a downward trajectory, and the money supply now is growing at 4.5% per year. Money supply measured by M2, which is the broadest measure that the Fed lets us see, M2, and 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 that's below Hanke's golden growth rate of about 6% per year, a rate consistent with hitting a 2% inflation target. So the pulling inflation down, 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 down. Now, what we have to be thinking about is maybe there's a pivot in the winds, because you said quantitative tightening. Well, that's going to stop in December. That's one factor. And we anticipate further reductions in the Fed funds rate. But more importantly, we've got the supplemental liquidity ratio, which is put on commercial banks, which produce most of the money. And that supplemental liquidity ratio, the reserves they have to hold for liquidity purposes, that's going to be eliminated. So the banks will have a lot more capacity to lend than they do now. And they produce actually about 80% of the stock of M2 has been produced by commercial banks. So what do you have? You have maybe a big loosening coming up. Plus, you've got you've got every day almost, you've got either Besant, the Secretary of Treasury, or Trump himself uh, whining because the interest rates, the Fed funds rate, aren't falling fast enough. So you've got and you've got the deficit overhang. So there's pressure on the Fed to monetize the deficit. So
Yeah.
all of that says what? It says maybe. I'm not saying this is going to happen, but it looks like things are getting set up for a significant loosening of monetary policy. And if that's the case, you can kiss the inflation contraction story away. The inflation will go up. It won't keep going down. Right now, the monetary pressure is to pull the overall inflation rate down, keep pulling it down. But if the money supply is altered and significantly jumps up, we'll have a jump up in inflation. So the that's what's worth keeping your eye on. Looking ahead, what is the quantitative tightening? What is the removal of the supplemental
Right.
liquidity ratio? What is this huge deficit going as far as the eye can see? What implications do all of these have for what? Changes in the money supply, because it isn't interest rates that affect or determine monetary policy. It's changes in the money supply. So
Yeah.
that's how I see it. The money supply is a key driver that determines the course of nominal GDP, and nominal GDP is the real rate of growth in the economy plus the inflation rate. That's the nominal GDP, and that's determined by where the money supply has been going prior to whatever date we're looking at it today. Well, where we're at today with nominal GDP has been determined by what happened to the money supply 2 years ago.
And Steve, I mean, if their goal is to keep the GDP rising and mitigate the debt to GDP ratio, one way, I mean, GDP at the end of the day is just money supply times money velocity. Now, money velocity, we don't have as much control over as we do money supply. So, don't the incentives for the policymakers lie in just expanding out the money supply to kind of mask some of the economic activity that's not so hot by propping up GDP that way?
Well, that's number one. The velocity thing is kind of a bugaboo, because it actually, in the United States, as well as John Greenwood and we just had a lecture in Buckingham in the UK this morning at Tim Congdon's International Monetary Institute, and we've done a big study of about 70 countries, and you end up with what the trend rate of growth or change in the money velocities very constant in all the countries. The only anomalous one has been the United States, and actually that was stable before 1946, and then after about 1990, it's been pretty stable. In between was a different story. That's why it's anomalous. But so so velocity is pretty constant, the trend, and that means that changes in the money supply directly affect inflation. And I've looked at a number of countries, 69 countries actually, and sure enough, the correlation between changes in the money supply and inflation is about 0.95. I looked at it from 1990 until 2023 in 69 countries, and that's the correlation coefficient. It's almost 1 to 1.
Yeah. Well, that's very interesting. And then money supply obviously finds its way into the markets. And I want to share my screen back here again, back to the S&P, kind of take it full circle. Let's go ahead and share this. Okay, so here's the S&P, and what you'll notice is, from a seasonal standpoint, the S&P today versus the 5-year average here in blue, and even where we were last year, we're tracking well above um, both cases. And if you look at what's happening with the S&P, some of this consolidated news data, a lot of it is based on the news of the shutdown being resolved. So here we can see all the different positive developments and negative developments and so forth. One of the big positive developments is the fact that the shutdown has resolved. What difference is this a big deal in your eyes? What are some of the ramifications, the downstream effects of the government being shut down for 40 plus days now? Now that's coming to a close. What does that mean for the markets moving on ahead? And of course, we've got some of the concerns in the market as well. Economic uncertainty, like you kind of pointed out. And then, given the fact that the market's risen so it's far above where it is on average from a seasonal standpoint across many other vectors as well, there's some concern there as well. But when it comes to the government shutdown, was that holding back? Was that a severe headwind against the markets, or are we poised to move on higher because now that's coming to an end?
Well, it had a negative effect. Let's talk about the economy. It had a negative effect. Haven't measured it exactly. It would have had, if it would have continued, it probably would have had a serious negative effect on the economy. As it turns out, it had a negative. It definitely had it was a negative, not a positive. And the measurements really aren't in on that yet. For one reason, they're not in because the government's been shut down, so we don't have any data, any measurement. Right. But so I would characterize it as having a small to modest effect. It did have over what was happening to the economy. If it would have lasted much longer, it would have obviously had the magnitude of the effect would have been a lot greater. But we don't really know exactly even the short-term effects that it had because we don't have the data. So, was it a negative in the market or not? Well, probably, if anything, a negative. But the key thing with the market is that the market's in a bubble, and if you look at the cyclically adjusted PE, the CAPE measure of Robert Shiller, that's definitely in a bubble. Second highest level it's ever reached. If you look at the Buffett measure for U.S. market cap versus GDP, that is in an all-time high. If you look at my Dr. X's bubble detector, it's at an all-time high. So the market's in a bubble.
Yeah.
And the shutdown certainly didn't pop the bubble. I don't even think it let much air out of the bubble.
No, not at all. I mean, year to date, we're still up 14%, as you can see here, or actually 16%. A year ago, 14%. I mean, just over the last 5 years, we've almost doubled, up 90% in the market. So it's just been nonstop to the upside. But the thing is, when you control for, I guess, the money supply, like it kind of goes back full circle, and you account, you price the market in, let's say, something like gold. The market is not in a bull market. Actually, it's getting close to being in a bear market relative to gold, being, the market itself being priced in gold. Is that is that not significant in and of itself?
I don't think so, but it's a fact. I don't know what you do with it, but it is a fact, but I don't know what you do with it. I mean, I know what the bulls will do. They'll say, "Oh, all these standard measures for bubbles are just baloney. you've got to price it in terms of gold, and if you do, it's
Hmm.
it's not as it's not as bubbly as you might think it was. That's about the only interpretation. But all the standard measures, the bubble measures, make it very clear that we're definitely in a bubble.
Yeah. Well, it's hard to argue against that. And what about the price? Actually, one more thing. What about the price of oil? Oil is currently trading at $58. You look at the price of oil, it tends to move in tandem with the price of silver and the precious metals, but there seems to have been a divergence between the two asset classes, oil and gold and silver. Is oil bound to revert back to the mean of and just correlate back with the metals, or is oil just is acting as more of a symptom to a weakening economy here?
Well, it's the bottom line is oil probably it's going down, and the reason that it's going to be weak is because the incremental demand that is out there can be all supplied by non-OPEC plus producers. So, and OPEC has all the excess capacity. So it's a supply and demand thing. You've got demand growing, and that demand can be met, that incremental demand, by all non-OPEC producers, OPEC plus, I should say, including Russia, OPEC plus producers can accommodate all the demand at this price. So what's that mean? That means probably the price is going down because you got OPEC producers want to produce a little bit more, and that's what they've indicated they're going to do.
All right. Well, sounds good here, Professor Hanke. Anything else that you'd like to get into before we sign off here?
No, not really. We've covered quite a bit of the waterfront, I think.
Yeah, I think so too. So much appreciated for your time, Professor. Always a pleasure. Where can people find you if they want to see more of your work?
Well, they can follow me on X, just at Steve underscore Hanke. If they want to read my most recent book with Matt Sakurki, is Making Money Work. You can pick it up on Amazon or any variety of it's any place online that sells books is selling that book.
Yeah.
It's Wiley released it in May.
Yeah, we'll have the links to your Amazon page down below. So if people want to buy your books, they can do so there. So be sure to check it out, guys. We also have the links to your Twitter page as well. Thank you so much for coming on, Steve. Always a pleasure. Guys, if you enjoyed this podcast, drop us a like and comment. Go, Steve, go in the comments section. And by liking and subscribing and commenting, you do help in pushing us in the algorithm. So much appreciated there. It may not seem like much, but a little bit does go a long way. And let me know your thoughts. Let me know if you agree or disagree. Either way, I do, in fact, read the comments. And then finally, again, I'd like to remind you and encourage you to consider becoming a member over at the forecaster.biz tool. It's a fantastic tool. You've got access to AI. You've got access to a number of different advanced technical analysis tools at your fingertips you're not going to find at most other places. So we've got the link down below for that. Check it out, guys. And until next time, I will catch you later.